Canada's Prime Minister Mark Carney spoke to reporters before flying to Malaysia for the ASEAN summit. Here are some of the highlights from what he had to say. It was a very quick little news conference on the tarmac. He said, "We can't control the trade policy of the U.S." Of course, all this is in response to what Donald Trump said last night, saying that all talks are off right now with Canada in the wake of that commercial run by the Ontario government south of the border. That was Ronald Reagan. So Carney said, "We can't control the trade policy of the U.S. As well, the government stands ready to pick up on progress in trade talks when the U.S. is ready, and that Canada plans to build or can build new partnerships, including in Asia. And the U.S. trade talks have focused on sector-specific U.S. tariffs, and progress has been made on those." Well, it's been quite a little battle now between the Trump administration and the government of Ontario. The latest one, of course, is the Reagan-era ad that we were just talking about. Donald Trump says he's done with trade talks with Canada for now after the government ran that. It featured the voice of the former U.S. president. And what's the impact on all this on the financial markets? Well, let's bring in Tim Murray from Capital Market He's a capital market strategist at Rowe Price. And Tim, right now, it's having a positive effect, it seems like.
Yeah, I think what's going on there is the market is kind of saying, we think this will get resolved. I mean, we have a lot of experience, unfortunately, over the course of this year with the sudden escalation in trade tensions, and they always seem to get resolved. So I think the market's saying, nothing to see here. I will say that I think it is certainly concerning when I look at that. I know it's not surprising that this is a hot button issue for President Trump. Reagan is an absolute conservative icon, amongst the Republican Party. Is almost deified. So not surprising that anything involving Reagan is going to cause a response from Trump. And I would think he would want some sort of concession before he's willing to start back up with trade talks.
And any indicators what he might ask for as a concession?
Yeah, that's hard to say. I mean, I think he'd probably just want something nominal that is either an apology or, I'm sure that he would love for the ad to not be run anymore, but not sure if Ontario is going to be willing to do that or not.
And from the market point of view, are we in almost like a post-Trump market in that people hear his reactions, hear what he has to say, but they just hold the course?
Yeah, I mean, the big term that's out there is the taco trade. Trump always chickens out. Is this the kind of the what the markets have decided? I think that's an oversimplification of what's going on right now, but it thus far has worked. I think the bottom line is that thus far in all trade negotiations, one, this is kind of what Trump's playbook has always been. You escalate right before the negotiation and try to get the best deal possible. But ultimately, you make a deal before there's any real economic damage done. So I think that's what's going on here. But we'll see. Like I said, this is kind of a political issue more so than an economics issue.
And we saw the CPI out today, the U.S. Economic activity. Does it seem like everything is going along, or are there areas of concern to you?
Yeah, so I think from the CPI standpoint, we've kind of had this tacit admission, certainly amongst the Fed, when you look at the last summary of economic positions that are economic projections that came out during the September meeting. And it basically, the projection was that we're going to get 2 more cuts over the rest of this year, which would say we're going to get one in November and one again in December. That's despite the fact that we have 3% inflation, and we've had 3% inflation. And if you go back to kind of where we were 2022, we got up to 9% inflation. That came down pretty quickly. It took about a year to 3%, but we've been stuck at 3% since I believe it was June of 2023. So over 2 years, kind of stuck right in this 3% area for CPI. Mm-hmm. And I think that's should be a concern. But thus far, there's kind of this tacit admission that we're okay with 3%, even though our target is 2%. With the labor market showing some weakness, we'll be okay with 3%. If the alternative is to go into recession, right? So labor market weakness is saying If you really keep rates too high, there's a risk of recession. So as a result, I think they're willing to cut. That said, there's a difference between 3% kind of and going sideways and 3% trending up. And that's really where we are right now, is 3%, but trending up. So I think there's going to be a lack of data. We got the print today for September. It looks like there's not going to be one for October. The labor market data is on hold. So, because of the government shutdown, it's not clear when we're going to get more data. I think that means that the Fed just stays the course kind of where they were, because they won't have data to kind of disprove what they had planned on doing. But when you start there in early 2026, and we do start getting data, hopefully, that's when we really could see a debate heat up between, is inflation trending up? Because 3% and trending up is a bit more of a problem than 3% sideways.
Okay, and then let's just turn to the markets for a second. Are they too expensive right now? Or are things going so good that it's hard to make a decision, hard to make a move now?
Yeah, I think the context that I'm thinking about this is that there's a famous quote by Alan Greenspan that he made in a speech back in 1996. Which he called, like, what was going on with the markets, he called it irrational exuberance, right? So, and ultimately it led, we got the tech bubble there, in the early 2000s. When I look at what's going on right now, I would say absolutely exuberance. So you can put the check mark next to exuberance. Valuations are very high relative to history. They're almost to the level that they got to in the tech bubble. But that said, I wouldn't call it irrational. If you look at the underlying fundamentals of the stock market, we've got earnings growth for the S&P 500 projected to be 13% over the next 12 months. It was 11% over the last 12 months. The earnings estimates keep climbing. The ROE, which I think is a really important metric to look at, it keeps going up and is probably expected to go up further. So the underlying fundamentals say this exuberance is justified for now. Now, it's certainly possible that we will get too exuberant in the future, but for now, I think it looks okay.
And what could trigger that too exuberant?
I think it's just, we are in a period where there's an extremely aggressive build out in AI infrastructure. And like I said, for now, I think that the amount of build out that's occurring, the pace of the build out, is not yet unjustified by kind of what the potential profits companies could get from AI. However, if it keeps going and keeps going, there's a limit to how much building there needs to be. And right now, it seems like there's a new deal signed almost every day. And so I think you have to pay attention to, okay, what could the real productivity enhancements be for the economy? How much profits can that produce versus how much is being spent on the infrastructure? Okay. So I think right now, have we gotten to the point where too much has been spent and so much infrastructure has been built out that we get an oversupply situation? That's when you get the bubble. That's what you need to be worried about. So far, it looks okay, but it's something we'll be monitoring.
Okay, Tim, thanks for joining us today. I appreciate it.
Thank you.
Tim Murray is capital market strategist at Rowe Price.